All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. We have a little dirty work here to do. We have Dollar General, which is taking a bath here today with the market selling off here, kind of returning to the lows from the day that it triggered or the day after it triggered. Here, not a lot of volume on it. It's one that I would expect to go higher, but we're on our time stop and we're on our price stop or below our price stop, so need to pull Dollar General here and live to fight another day. So let's go do that here. Let's see, bid ask $1.45 to $1.50. Let's see here. I'm just gonna put in $1.45, and they filled me at $1.49. So out at $1.49 here. And let me just make sure the alert goes out. We'll talk about it a little bit. All right, 5 contracts at $1.49 and gone. All right, there we go. All right, let's see here. We're into the exit, $1.49, and trade close date 131. So not a great end to the month. Leaves the challenge, up almost $700 here, but in a really kind of interesting month for it. Went back and looked at some of the data to see, other months that were similar to this. By similar to this, I mean a month where we had 3 stocks hit their stop loss and 2 hit their price target. Nothing ever got stopped out with the time stop. Not a single trade hit its time stop. They all hit price stops, one or the other. Here with it, and Starbucks, Disney, thanks to Missile, and then we got Pepsi, Netflix. Okay, great. And then Dollar General here, just we bought it in more of a bearish style market, was showing signs of wanting to go, but just didn't. So trimmed some of our gains there with it. Now, I realize that some of you out there are going to hold on to it. Hold on to Dollar General. There are some of you who have looked at the challenge trades over the past, since we've started with this, with the algorithm trades here, and have noticed that many times after I exit, the stock will still, go my way. What do I mean? Well, here's Starbucks, right? Popped out, knocked out with the Missile, and boom, off it goes, right? But I do want to caution and warn you, right? I do need to do that. And, there are the Disneys of the world where it doesn't, where it tanks, where, this is why the time stop, this is why the price stop is in play to avoid this. If you're like me and you have no aversion to a trade going to zero, then great. But realize that going against these stops, really does increase the potential of a trade going to zero in a significant way. And, if you look at Dollar General, light volume here today, right? Light volume, it's still in a pretty good position. It's, you can argue it's even held up pretty well, through all of this, and could easily be at 160 to 165 in 2 weeks, right? But gaps down, sells off. By the time you're able to get out, it'll be at 150, 149. What's the option value? It'll be close to zero. So realize that risk is in play, and feel free to go with what you want there. But understand those risks are on both sides. Don't get caught up in the Netflix kept going, or Pepsi kept going, or Starbucks kept going, and just kind of understand that risk reward factor. The bottom line is the challenge. It's a process, and for those of you new with this year, I hope you've been able to see that it's not about what does Jeff think and what's Jeff going to do and what's Jeff looking at and all of that. No, it's a process. It's a data-driven process that is is optimized to push the challenge into that $10,000 area, a higher percentage of the time than any other level, with the possibility of 100K if a few months of gains are stacked on top of each other, and to fit in the challenge risk reward philosophy where more we don't need a lot of gains to overcome a lot of losses. And it's one where, look, the market is what it is. We can model the data as best we can, right? We modeled Starbucks, we got our probability, it was great, but something happened. Okay, great, got it back, move on out. Those are going to happen, and we'll continue to run with the probabilities. And this is still a challenge that's off to a start where I fully expect that we will be up in that 10,000 area sooner than later. And one where, as we go into February, I'm not sure if we'll have as many entry triggers. We've had a lot this month, right? We've had a good number this month, but we will have more tradable triggers, right? I'm pretty confident in saying that. Now, we do have a trigger here today. We have Walmart. Walmart's triggering bearish. And you can see the downside 3-7 crossover, Stoke 39.1 below 50 there. We have all the elements in play for a downside signal on Walmart. That said, I'm not entering right here. This is one where I am going to invoke the challenge rule number 11. When new signals triggered and the option is more than 10% out of the norm, Jeff has the option to wait 2 sessions to trade it. And with the implied volatility jump here today, options are a little bit pricey, so I do not want to go chasing after it right here. And I'm going to hold off. I will take a look at it Monday, see what the options do here with it. We do have some pricing in terms of earnings, that we do have to account for with Walmart. And just one where, February 13th, that makes it a little tough to trade there. We're only 2 weeks away. And, yes, can it still be traded? Sure, but with the inflation of today's options, no. And so I'm not going to, go and trade that here today. Now, we do have a lot of downside crossovers on the board. Apple, Boeing, Chipotle, Dollar General, Home Depot, Procter, Under Armour, Visa. A lot of these, the Apples, right? I mentioned, I mentioned it yesterday that, I bought a put spread for Apple, the day of earnings. I bought a put spread for Apple down here at 300. We'll see if it gets there. It's not like I'm doing anything with it or, fine, $10 doesn't really do me much. But that was a way for me to get a little put exposure. Okay, great. But it's not a challenge trigger, there to the downside. Chipotle, Home Depot, Visa, very similar charts in how they're coming off of the highs. I was kind of hoping Under Armour would trigger, but it is not there. On the upside, we do have 2 upside crossovers. They're the same as this morning, and we talked about both of these, Amazon and IBM. Both of these are moving more than 2 average true ranges for the crossovers, so no chance of triggering there with them. But anyway, that's IBM and Amazon. If you want more on those, check out the video here from this morning. Bottom line, ugly day for the markets here today. And, it's one where we are seeing, some of that fear come on in. But when you look at normal pullbacks, this is nothing unusual. This is nothing, earth-shattering. This is nothing where you go, you gasp. Yeah, if all you remember is the last couple months of trading, yeah, it's a big gasp, right? It's a big gasp because this is a really big, move and trading outside, the ranges. But for those looking for a bottom, I want to show you something here. Let's just do it this way. Let's put on the average true range. Okay, there's a high tendency with the market that the market will drop as the average true range rises, right? What do we see? Average true range on the rise. When the average true range starts to fall, well, that's when we tend to see the markets go up. Look at October, November, December, January. Yeah, we had a little blip up, right in here at the beginning of December. But overall, falling average true range, rising market, right? Falling average true range here in September, rising market. Rising average true range, falling market. falling market, rising average true range. Falling average true range, rising market, rising average true range, falling market. You get the point. It's a very strong correlation, and one that we can see in the market vibe and everything else. But if you're looking for one indicator and you're saying, hey, I want to know when this is safe to maybe step in and buy from an investor standpoint to buy the dip, just wait for the average true range to at least top and better to start to drop, right? And that tends to be a really good spot. Now, the market vibe doesn't take into account the average true range, but when you look at some of the principles to the market vibe, it's one that would definitely fit into what the market vibe is. We continue to see the bullish percent index sell off here, and so look, we continue to have the market elements bearish. And we talked about it last weekend with the weekly chart on the S&P. It was holding up okay, but small caps and global stocks were not holding up as well. This week we see the S&P breaking the 7-day moving average, while small caps are continuing their sell-off and their breakdown. While things like China, they broke down in a very big way here, obviously due to the catalyst that is out there. We haven't seen bottoming signs here yet. In fact, when you look at most indicators, we're starting to see most indicators turn on down. And for someone to come out and say, well, bottom is in right here, that's very, very difficult to say and very difficult to argue. And it's one where for me, right, for me personally, I was looking for a little bit more of a bounce, right? We talked earlier this week. We talked about this 62% retracement, and a lot of times we'll push up into the 62 to 78. And yesterday at the close, we came up to the 62, and I thought, all right, we get a nice little update today. All right, we got a good chance to load up heavily short, but didn't get up high enough for me to really put on a lot of exposure, personally. And so, again, I'll be looking for bounces and using some of those same ideas that we talked about, this week to look for those opportunities. All right. Thanks for hopping on. Have yourselves a fantastic weekend, and we'll talk to you on Monday. Take care.